Hello and welcome. Happy Christmas, almost Eve. We welcome all of you here today on December 23rd. Today's class called the Investing Master Series. My name is James Boyd. Someone actually said I did a class before. I have short-term memory loss, so this is the only class I can remember. I did teach a class before. Glad you enjoyed it. Now, we also have Michael Fairborn with us in the chat. We welcome him and we welcome all of you here. We got Grace, Gary, Merry Christmas to you, Dom, Fayez, Sharon, JDL, and many others. Hopefully you got a nice little Christmas plan for yourselves and your family. Let's go ahead and get hopping. In today's class, again, we said we were going to focus. We established some curriculum we wanted to go over. And so really these sample plans are really, when you kind of think about, a lot of people say, hey, can you give me a little bit more context of what you're doing, how you're doing it, et cetera, why, et cetera. Well, that's the purpose of these strategy discussions. Today's date, the 23rd, we're going to talk about the cover calls. And so these will be some of the dates, and I've posted this on X. Join us there. That way you can see our announcements as well. So we're going to tackle this topic. We're going to hop right in. Now, remember, with what we discussed is done for example and illustrative purposes only. Also understand when we talk about options carry a high level of risk and are not suitable for all investors. When we talk about investing, when we talk about these short options, that could be selling calls or selling puts. Remember, those can be assigned. Today, we'll talk about an assignment. What does that really mean for a cover call? And also remember, they could be assigned up to expiration, regardless of the in-the-money amount. It's a standing obligation to sell or to buy. Now, remember, when we talk about our examples, they will be just that. Let's go ahead just real quick and hop right into this sample plan, okay? So I want to kind of write just real quick this sample cover calls sample plan. Now, the biggest actually thing is a lot of you actually in the comments said, James, it's been really nice to go through the sample plans. And as you have reviewed your own sample plan, many of you have said, my sample plan includes many of the things that you discuss, and many said, I feel positive about that. Well, it's nice because what you find out is there's principles that are timeless and practices that are timely. You sure hope that actually over time you find out what those principles and practices are, and you try to do those. Now, when we talk about the cover calls, there's really what's called a buy right strategy, and we're going to hop right into an example. Buy right strategy, which is really buying shares plus selling a call. And the purpose of this is you're not trying to time, okay? To time. If we actually said, hey, we're going to leg in, this is where we're buying shares, okay? And later selling the call, okay? Now, I want to look at two examples. I think the best thing we could do is we could just talk about like the car on the outside. Let's just get in and drive the thing. Then we'll kind of find out what we like or don't like. So this is where you're trying to time. Now, the example that I want to look at first off is I want to look at the example just real quick of NVIDIA. And I also want to look at the example of, let's say, Google, okay? But let's look at our first examples. Now, if someone said, well, where would I start, assuming maybe I'm beginner or intermediate? If I was that investor practicing in the paper money, I would focus on buy right first. As your technical analysis becomes better over time, which makes sense, you might say, look, I can see the setup better. I know what I'm trying to do. You might try to actually maximize the upside potential and the timing of selling the call. So what does this really look like? So first off, what I'm going to do is I'm going to pull up just real quick NVIDIA, okay? Now, if I ask you, what do you see with NVIDIA, what would you say that it is? I mean, now remember, if you're going to buy 100 shares of stock, remember, it's your capital. Would you want a company that doesn't make any money, that's struggling in its industry group and its sector, and it's not in an upward trend? That wouldn't, and is not liquid. Does that make any sense to you? Many investors would say it doesn't make any sense. If you're going to buy the shares of stock, you got to think the company makes money. It's strong actually in the sector, the industry group. It's actually something that's liquid in terms of the stock and options, et cetera. So it makes sense. It kind of piggybacks on our discussion of, let's say, trading the trend and also swing trading. Now, how does someone just do like a classic buy right strategy? Well, step number one, we're going to go to the trade tab. And again, we're going to kind of learn and talk about it as we go. We're going to go to the trade tab. We're going to type in, let's type in NVDA, and how do we just buy those shares of stock? Okay, so if I buy the shares of stock, we're going to click on the ask price. Remember, if we do this, we think that on the chart, technically, we're actually seeing something that a bullish investor might like a bounce, like a breakout, like a crossover, like we talked about yesterday. And if we come in here, I'm going to click on that ask price, and we need to buy 100 shares. Now, I don't know what your threshold is in terms of buying 100 shares. I'm going to say our examples, we're going to try to buy anything stock price-wise that's less than $200, meaning that if we buy 100 shares, it's no more than 20,000. I'm not saying we can't go lower. I'm just saying we're going to try to focus on stocks that are not as high priced. If you said, James, that's not my situation, I can buy anything I want. Well, disregard what I just said, okay? Now, what we're going to do now is go to advanced order, and we're going to go single order. We're going to go first triggers SEQ, okay? Now, just for this moment, I'm going to go to the monthly option, and what I'm going to do is I'm going to decide that we're going to sell, in this case, example given, like the 192 strike. Let me give you a picture. I could tell you in words, or I can show you in picture. I'm going to hit you with both. If we buy the shares of the stock at 186.60, we're agreeing from now until expiration to sell these shares at 192. Now, stop for just a second. Why would you agree to sell the shares at all? Well, number one is you're still making something. I mean, you can't be too greedy, right? 186.60 up to 192. So you got a difference there of about, what, 540? And you wouldn't agree to do so for free. And actually what the investor is getting paid is they're getting $4. So they get two things. Well, maybe three. Number one is to get the stock price from there to there. We said 540. But we're also adding the second piece, which is the premium. What's the word of the day? Premium. Now, James, is it also possible if the company paid a dividend that we could also try to get the dividend? That's the third thing, okay? This is a covered call, okay? Now, if we did this example, if I go in and confirm and send, and I send this order, that is a covered call, okay? Now, if I also, so that what we just did is what's called a buy right. You're not trying to time it. You're trying to pick a stock that actually is bullish. You're trying to actually sell something where the premium is decent. We'll talk about what that is in just a moment. I'm going to just show you a picture of something that might be more of a leg in strategy. If we looked at a stock like Google, what do you see on Google? Well, if we actually kind of looked at Google, it kind of looks like this is a fresh, smell that? Fresh crossover. Well, when we talk about the timing of covered calls, we don't want to be putting on like a brand new trade if it's just starting to break out again, where we actually think it might try to go above that upside resistance on the chart. This might be an example where the investor says, A, I'm just going to buy the shares. 2, the investor says, look, I don't want to sell the call until we get up to this area of resistance. So what is that really doing? Well, if the investor buys at 315 and they say, look, I'm not going to sell any covered call until we get up to high 327s, they're trying to maximize the upside potential, meaning it's not diluted by selling the call. Because if we go from 315 to 327, that's $12. $12 on 100 shares, $1,200. Okay? So when someone does this strategy, they're saying, look, I'm getting in on a bounce, breakout, crossover. Now, could a crossover actually be a bounce or breakout? We hit that yesterday. Yes. But you're saying, look, I like the setup. I want to buy the shares, but I do not want to sell the call. We'll talk about why in just a moment. But let me get this actually set up. We're going to come in, buy those shares, 100 shares of the stock in this in the paid money account, if I can. We're going to finally see. Let's see if it takes it. Okay. So we're going to come in here and click on Google. Now, don't worry. I'm going to backfill in what we're doing. Okay. But at least want to kind of put them up. That way we can kind of reference the picture that we're doing. If I come in here and say buy 100 shares of the stock, here it is right here. Just buying the shares at the mid price. Confirm send, put it right there. Now, don't worry about the stop right now. I just want to get these trades going so we can actually reference them, okay? So 2 terms we actually talked about. The buy right, the investor's not trying to time. if someone's really doing the buy right, what they're saying is that they are okay with the current max gain, premium, and break even. And I'll show you those numbers. They're just saying, look, I'll take the max gain. Okay. I'm fine with that premium. And I like the break even. If they're actually doing, for example, the leg in, the keyword is they're trying to maximize stock appreciation before selling the call. All right. Now, if we take a look at this is why it's critical. Now, again, we need 100 shares. Okay. Need 100 shares minimum. This is why liquidity is so critical. Now, I'm just going to speak to it. Okay. This is why we always talk about like shares or companies that are in the Dow 30, NASDAQ 100, S&P 100. I'm not saying they can't be in the S&P 500, but the three lists we're going to look at first, Dow 30, NASDAQ 100, S&P 100. Why? Because those are the stocks that actually have typically liquidity on the shares. If they have liquidity on the shares, a better chance to have more liquid options. That doesn't mean 100%, a better chance though. Okay? Now, the purpose, capitalize. What's the purpose? What is it that we're really trying to do? We are trying to get stock appreciation. I'll put it in caps so we can read it better. Stock appreciation, but we're also trying to get a premium. And that premium, we're trying to also make where we have some stock direction, but also premium from time decay. Now, where I'm from, that's how we would spell decay. Okay, now, when we take a look at this, is we're also trying to say, look, if we do a cover call, we think the risk of the stock pulling back is less than 5%. Now, how do you know that? We don't know that for sure. But we actually think, look, if it were to fall down, the support is pretty close. We think there's a pretty good chance it could stay above support. Could it fall down lower? Absolutely. If you thought the stock could fall down lower than 5%, a cover call is an income strategy. Okay? Not a protection strategy. Okay? Now, the key thing is here. When we actually take a look at this, the cover call is the 101 for a caller. So if someone said, well, why would I care about a covered call? Well, you'd want to know a covered call because the caller is just the next step. The caller is an income strategy with protection. And let me ask you something just real quick. Have you ever been in a situation where you said, man, I sure wish I protected some of my shares? Do I have your attention now? How did it feel when the portfolio went down 5, 10, 15, 20, 25, 30%? Do I have your attention now? No, I've been there too. That's why I have my attention. That's why I'm kind of saying that. Okay. So why would I want to know about a cover call? Because the cover call is the stepping stone for a caller strategy. The cover call is an income strategy. The caller is actually really income and protection. Now, the biggest actually thing is, if someone actually does a cover call, what are they also thinking? They think they could be, okay, at a short-term top. And I want to talk about kind of the consider application question mark, okay? You think you're kind of at a shorter term top. We would really label this really as trend 4, okay? And I want to asterisk this, not 3, okay? If you are in trend 3, you're trending. You're making higher highs, higher lows. Now, if you did do a cover call, what is it that you're really saying without you maybe even knowing it? You're okay with the current max gain, premium, and break even, okay? We are trying to actually time those and say if we're going to put those on, we want to be in trend 4, which means we're probably at a shorter term top and or resistance level. You're probably also, for example, let's say maybe the market could be up near resistance. Our stocks and indexes could be similar. If the market could be up near resistance, the stocks could be up near resistance. If the market and or stock is up near resistance, you probably actually have a situation where the VIX is low and could be diverging. Okay, now, did I say the word we could be up near a short-term top? Trend 4, okay? The market the sector, the stock could all be up near an area of resistance within 1 or 2%, and the VIX could be low and diverging. Now, the other time that I would actually probably say might be a time of interest is the stock has upcoming earnings within 5 to 7 trading days. Now, why is this kind of maybe a potential interest? Trading days. Why? Well, that IV would be nice and puffy and fluffy. Higher IV percentage. Higher IV percentage means higher premiums. Higher premiums, higher max gain. Higher max gain, higher premiums equal lower break evens. All right, so that's kind of interesting. We'll talk about that in just a sec. Now, so those would be kind of some times. So we talked about what are like the cover call like types. We call them buy, writes, leg-ins. Talked about what do we need? 100 shares liquidity. Okay. When we say liquidity, again, like I said the other day, 1 million shares average. We'd also like to see the option bid-ask spread 20 cents or narrower. Okay. We talked about the purpose. We talked about consider application. And now when we actually go down and kind of look at some of the stock volatility preference, okay? When we pick option strategies, it's important to kind of look and see what the implied volatility is. So when we talk about the stock IV preference, now, if I were to actually look at this, I'm going to kind of write the examples we might be looking at as 25 to 34, okay, percent. Now, I'm going to asterisk this, which is if IV is, let's say, 15 to 24, the investor might consider just buying a put, okay? Because the lower the IV, the lower the premium, the lower the break even, the lower the break even. And also that lower, if the IV is lower, that allows the investor to buy a strike closer to the current price typically. And that means the protection is closer to where the current stock price is. So if that IV is 15 to 24, that also tells us that the premiums that we're probably going to get are not going to be enough to make the investor say, yeah, I'll sell the call for near nothing. Does that make any sense? No. So most of the examples we're going to be looking at is saying, hey, if that call actually has, if the stock has an IV at 25 to 34, it might be more attractive to sell those. Okay. Now, when we talk about, let's say, the structure, okay, so when we talk about the expiration month, strike, now I've talked about this in both ways, okay, and I'm just going to hit this. We're going to look at the 20 to 50 days, 50 days to expiration. We're going to look at the monthly options. I'm not saying you can't look at the weeklies, but I'm going to say that we're going to start by looking at the monthlies. Now, historically, as you kind of test things, we've also even looked at examples of 70 to 100 days to expiration. Now, there might be some reasons to do that, considering maybe market conditions, okay? And I'm not going to write this in full. If you're trying to go out 70 to 100 days, you're trying to get a bigger premium, you're really saying the market or the stock might be more neutral and you want to be less active in terms of managing the position of the call. All right. Now, if the market was more bullish, the sector's more bullish, the stock's more bullish, you might say, look, I am not going to lock up my shares for that long. I'm going to try to focus on something that's more shorter term. 20 to 50 days to expiration, okay? Monthly options, and the strike selection, for the most part, is probably going to be in the ballpark of, let's say, 30 to 40 delta. That tends to be 2 strikes out of the money, typically. Always no, okay? Now, let's say you said, hey, James, I want to actually sell something that has a 20-30 delta. Well, what does that mean? Well, if you sell something that has less chance to be above the strike at expiration, there's less premium. Now, when might the investor say, I'm going to go the other direction? Well, if the investor says, James, when might the investor say, I'm going to sell something that has a 40 to a 50 delta? When might they do that? Well, they probably would actually do that maybe considering around earnings when IV high. So is it always 30 to 40? Well, no, it's not always 30 to 40. That's probably a starting point. If you want to have lesser chance of actually being have those shares assigned to somebody else, you might go delta 20-30, assuming that the premium is actually still fair. If we said, I don't mind to have my shares assigned to somebody else at the strike price, I'm going to sell a strike that has a delta of 40 to 50. Bigger premium, higher max gain in that case, given the higher premium. And where around earnings, I think the stock might be more volatile. The only protection on a covered call is the option premium. The covered call is the right to sell the shares at the strike price, the obligation to sell the shares at the strike price. It's not a right to sell the shares like buying the put. And that's why the covered call is an income strategy. Now, what I want to do is I want to kind of walk through just real quick some of the numbers, okay? Now, if we take a look at some of the numbers, I like to call this, now we know that if we said dividend yield, okay, dividend yield, well, we take the annual dividend, okay, divided by current stock price, okay? And we know that. Man, guys, so we know that, okay? Now let's take something pretty similar to that. We're going to call it option yield, okay? Now, let's assume that the premium is $3, and let's say the stock price is currently at $100. So $3 is the option premium, and the $100 is the current stock price. Okay, so if we did this same idea as dividend yield, we get a yield expressed in percent. Well, it's 3%. Now, when we're actually kind of looking at, let's say, I like to kind of bracket this in low, medium, high. Now, if we take a look and said, hey, the premium expressed in percent is only 1.5, it's okay. It's just less, okay? Now, that might also be that, A, the call that you're selling is higher. You also might be selling something where there's not that much time to expiration. You also might be selling something where the IV is lower. Those are the three major factors that it could influence that. If we said that, hey, maybe the yield percentage is 2.5. Well, why would that be higher? Maybe the IV is higher. Maybe the strike we're selling is close to the current stock price. Maybe the option that we're selling is kind of more in that typical 20, 50 days expiration. And if we actually said, hey, this percentage is 3.5%, why is that higher? Well, the IV is probably higher. You're probably also going to see it's probably in the range of 20, 50 days to expiration, and the strike we're selling is probably close to the current stock price. So when you start kind of adjusting those three things, it's changing the option yield. Now let's put some numbers to this. Now the example that we actually did before, we did NVIDIA. And when we actually looked at NVIDIA, let's go back to this. Let's go to NVIDIA. And it hasn't filled yet. Now what I'm going to do in this case, dadgummit, okay, stock went up. So now we're just going to have to get into the current price. And by the way, it's so hurtful because that could have filled 70 cents ago. So I'm going to come in here, go confirm and send, and just try to get filled at the mark price. And there it is. So this is your classic covered call. Now, what we need to know about these covered calls is the option Greeks. You're going to see that if someone did a covered call, it's not as bullish as owning the shares. Why? Well, because you put a cap on. Okay? So let's think about this like your house. Your house is $1 million. You have not agreed to sell your house to anyone. Well, if your house literally was found to have oil underneath it and now it's shooting up to $10 million, yeah, you're getting dollar for dollar pretty much. Okay? But if you agree to sell your house to someone else for $1.1 million, it's not as bullish as someone who has not agreed. Same idea with the covered call. Now, in this case, let's run through these numbers. We bought those shares at 187.33. Let's type it in. 187.33. That's the stock price. Okay? So NVIDIA, current, let's say the entry price. Entry price. Now, what was the option premium? Well, that option premium, how much was it? And I'm going to tell you right now, I have never ran into anyone who did this strategy or any option strategy that if they did not know how to run through the numbers, it almost certainly was that they didn't do the strategy. Running through the numbers is a part of considering or doing the strategy. So you want to make sure we're locking in right here. Got the entry price, not too hard, okay? What's the option premium? That option premium is 440. And remember what I said before, to find out the yield percentage, what were we doing? We said before, we're taking the option premium divided by the current stock price or the entry price. Since we just got in now, that's why I'm quoting the entry price. So all I'm going to do is take 440 divided by 187.33. And what does that do? It gives us 2.35. So we're kind of more in this area right here. Now, does the investor want to go out and look for something that's 3.5%? Is that better? No, it just means it's more volatile. Most of our examples are probably going to be right in this realm. Okay. Now, we also want to kind of see what is the, let's say what's the strike sold. Okay. So the strike sold, what do we got? That cap is 192. Why do we want to know that? Well, we want to know the stock appreciation. Stock appreciation is from 182. Okay. From where we got in, 187.33. Okay. So there it is right there. And just so we're 100% clear, that's going to be strike sold minus entry price, just so you can follow along. Okay. So we got some, now we want to look at max gain. Max gain, just so we could all follow along, is really going to be the stock appreciation. Sorry for any spelling, but you get the point. Plus the option premium. Ooh. Now we're going to add these together. Option premium, or let me go back to be in order. Stock appreciation plus option premium. What do we got? It's 907. Now the problem with just looking at a dollar number is $9 the same if we said $9 on $187 stock or $9 on $1,000 stock. I don't know how to really compare that. So that's why we kind of like to look at the covered call max gain percent. So that way, if we're looking at maybe something like Wells Fargo at $80, or we're comparing it to something $800, well, that is going to be the $9.07 divided by what we paid for the stock. I'll write that down so you can follow along. That's really going to be the max gain, a dollar amount, divided by the entry price. Now, is that helpful that I kind of write that down where you can see where those numbers are coming from? Now, by the way, I've never met a millionaire that wasn't good at numbers. Kind of makes you wonder, how did they become a millionaire? Now, I'm not talking about giving money. I'm talking about you made it yourself, okay, over time. So now, by the way, we're not doing any trigonometry or anything. We're just talking about one number divided by a number, adding up numbers. This isn't complex, okay? So we ran through these numbers and we said, hey, the maximum gain, 4.84. Now, I'm going to kind of say something just real quick. If we kind of said like the lower percentage, I'd probably say 3 to 5%, okay? When I look, and I'm going to call this really the max gain percentage. When I look at, let's say, these numbers, I'd probably say if the option yield is 2.5%, I'm thinking these numbers are probably going to be about, let's say, 5 to 7%-ish. If I actually said, hey, that option yield is 3.5%, I'm probably thinking it's going to be 7% plus. When you run these numbers over and over and over and over, you see these same numbers playing out over and over again. Now, there is some value as far as running these numbers over and over again, okay? I could go into a story, but I won't. But just know that you should run them. If you see any numbers that are extremely different than what I'm showing, you should say something is not quite right, okay? I'll leave it at that. So we're right around. So when we saw the option yield at 2.35, we're right there. I said if we looked at the maximum gain, it should probably be around 5 to 7%. Where are we at? We're at 4.84. These are just ranges, okay? So now what I want to do is I want to come back to this and just talk about just really quick. When we do a cover call, I just want to talk about delta just real quick, okay? When we buy 100 shares of stock, that really equals 100 delta. Okay, the 100 delta is telling us the rate of change of the profit or loss. Stock goes up $1, we're up $100 unrealized gain. Stock goes down $1, unrealized loss of $100. The rate of change, number of shares equals the rate of change of the profit or loss. But when we sell the call, is that positive selling a call? Well, if we sell a call, is that positive or a negative delta? Is that a bullish or bearish position? Now, if I said, hey, we're going to buy a call, nobody would say, oh, that's bearish, since you're buying a call. When you sell a call, that is negative, okay, negative delta. Now, in our numbers from before, if we buy 100 shares of stock, 100 delta. Let's say we actually sell a call with a delta of, let's say, 35. Your position overall is not 100 shares because you sold a call as well. Now here, let me ask you a question, okay? Take your best shot. If we actually go from 100 delta and then we drop down to 65, are we as bullish as what we were before? I already answered this question, I already mentioned it, but are we as bullish? We're not as bullish because we actually agreed to sell the shares at a strike price. And we're not as bullish because, well, it's going to show that we have negative 35 delta, example given, and the net delta is going to be 65. So whenever you have lesser delta, you're saying, I don't want to be as bullish. Now, wait, if you don't want to be as bullish, you're really saying maybe the price might be closer to resistance, the price might be more neutral, you might be more concerned about what the price might do. So when you look at a covered call, a standard covered call is probably going to have a delta of maybe between a net delta of, let's say, 60 to 70. Okay, now we're going to spend the next 15 minutes on talking about kind of once we put these positions on, like how do you manage the position? Okay, so now we did 2 trade examples, okay, or at least let's do one more and then we're going to talk about the management. So if we look at this, and when you say net delta, what do you mean by that? Well, if we buy 100 shares of stock, 100. If we sell a call, example given, negative 35. When you combine those, net 65. Now, let's just look at a quick example, and then we're going to talk about the management. I want to bring up an example that we could actually pull up. And one of them that I want to pull up for an example, I want to go back to which one? Okay. Now, if you don't mind, I want to go back to something that might be a little bit lower priced. And let's say you said, hey, James, I want to, for example, pick a stock that, let's start out with something like Delta, okay? Now, let's say we chose Delta and it's a $71 stock. All right, now let's use everything that we know so far. Is this stock on an upward trend? Yes or no? What would you say? Is the stock on an upward trend? I mean, if I drop this back, could we actually say there is a trend? Could we actually say there's been a intermediate to a shorter term type of trend? I think we can say yes to that. If I went back to kind of a chart that's kind of a little bit more lagging, if you will, if I went back to this chart right here and say, is there a trend where the price is above the 10-day exponential, which is consistent with what we talked about on the trend plane and the swing trade plane? I think we could say that. Now, what you're now going to notice is if I went back to that chart right there, there's earnings coming up. Now, that's not necessarily going to make us upset. We know that if there's earnings coming up, that the IV might go to the upside. Higher IV, it might actually cause the premiums to be bigger. Bigger premiums, we talked about that. Higher max gain, lower break evens, hence bigger premium, and the percentages are going to change. Let's look at this. Now, I'm choosing something that's lower price because someone says, look, I ain't going to get started with something that's $200 or $20,000. Let's start smaller. Because if we can learn it with the smaller dollar stock prices, why can't we do it with a bigger dollar stock price? That's the idea. Now, what we're going to do is let's go to the paper money account. Let's go, how do we do this in one shot, okay? Before we just bought the shares and then we added just 2 pieces together. But wonder if you just said, look, I want to go to the 20 to 50 days expiration, and I want to really, in this case, pick an option that has a delta between 30 to 40. Well, we got this one right there. You got that one right there. Those are the 2 that really have a delta of 30 to 40. Which one has a higher open interest? It looks like the 75. Now, let's kind of show how we can just punch through these numbers. Let's say that we bought the shares at 71. Why 71? We're just going to say it's easy math, okay? So what's the stock price? $71. I know it's at $70.97 for you detail people like I am. Okay, fine. Okay, well, we're going to say 71. What's the option premium? That option premium, if we got somewhere in the middle, About 142. All right. Now, if we got 142, there it is. Well, what's the strike zone? We know it's 75. Now, when we did the option premium of $1.42 and the stock price is at 71, it's a 2%. It's right there. Now, again, that might lead us to believe, like, what's that implied volatility? It's really 45. Well, why is it not as high as maybe it could be? It's because we're going down to the bottom of the range where we're barely above the 20 days to expiration. So you have lesser days to expiration. The premium's lower, and that's kind of what we're seeing. Now, the other thing about this is it's also is that the stock it's at 75. The stock would need to go up to 75. We make from 75 to 74, stock appreciation $4. Remember, what did we say max gain was? Max gain was really stock appreciation plus the option premium. Follow along, class. Now, if we say, well, hey, if I got 542 and I paid $71, the cover call, CC max gain divided by entry price is 7.63. So where's most of the gains coming from? Is it the premium or is it the stock appreciation? Answer, so everybody says, stock appreciation. Now, if we kind of said, well, what's the chance of the stock to be above the strike price at the expiration? It's only 32% chance. So not a high chance. Now, someone might do that if they want to have a greater chance to still have their shares, but there's still a chance that the shares could be assigned prior to expiration and or expiration. So how do we do this all at once? Let's do this. We're going to right-click on this option. We're going to go to where it says buy, and we're going to go to where it says covered stock. Now, once we actually do this, all we did, right-click, okay, buy, and now what you're going to see is covered stock, okay? Now, let's spend the last 10 minutes on just kind of talking about the situations. Now, if you've ever went to a class where I talk about a caller-like situations, the covered call situations are going to be similar. I'm going to verbally speak to them, okay? So if we take a look at this, I'm going to go buy covered stock, and could we set the stop? Absolutely. We could go single order, first triggers SEQ. We're going to right-click on this line and just flip the order. Create an opposite order. We're going to make the exit conditional. We're going to say, look, if you go at or below the 1 to 3 month support by greater than 2 to 3%, exit the covered call. Why? Why? Well, why? Because the investor has the shares. Why? Because the investor probably doesn't want to hold shares if it's falling down below support. Yeah, but I got the premium. You got to remember, the only protection on the covered call is the premium. You're holding onto the shares and the risk is all the way down to 0. Okay? Can you hear me? All the way down to 0. So don't think, oh, I got premium, it's protecting me. Because that premium, all you get maximum is the premium. Okay, that's a big point. Now, let's kind of talk about when we talk about, okay, once we put the trade on, let's talk about the situations. Now, remember, there's 4 situations, okay? 4 situations. Now, this sounds like kind of what we do with callers, and that's true. Now, I'm going to kind of speak to this. So when I say 4 situations, I'm going to say the stock is bullish. And the time frame that I want to kind of look at is after 9 to 10 trading days. And I'll just even say 10 trading days. Okay, after 10 trading days. I'm going to also kind of put right here, stock is bullish. Okay, prior to 10 trading days. Now, why are you so fanatical on this 10 trading days? Well, because when I went back and back tested, you got to remember something is if you put a covered call on and 2 days later it goes to the upside, you got to understand the investor could still participate, but it is capped. So the other thing is you're going to tend to get a lot of false signals if you put it on right. If you manage the trade inside 10 days, a lot of times if you go back and back test, you're going to find you probably wished you wouldn't have touched it. That's what many investors have found. Now, you find it out for yourself. Now, we're going to say the stock is bearish, and we're going to say the stock is flat. Okay. Now, I want to kind of speak to this. So you get in, you put on a covered call. The stock is bullish, meaning it goes to the upside. After 9 or 10 trading days, you want to define resistance. Now, one of the reasons why sometimes people don't actually do covered calls is they say, well, if it goes to the upside, now I feel like I'm capped out. You got to be okay with that, okay? From the standpoint is that you're still going to make something, okay? After 9 and 10 trading days, we want to define resistance, and we want to actually set a buyback 1 to 2% above resistance to buy the call back. Now, so I want you to kind of think about this, right? If you buy the call back, what are you left with? If you rip up the obligation, what do you got left? Remember, cover calls two things. It's the shares and the call. If I get rid of the call, all I have is the shares. That's it. So if you're saying, hey, I buy the call back, why are you buying the call back? Well, you're buying the call back because you're breaking resistance. If you break resistance, what trend are you in? You're in trend 3. Okay? If you're in trend 3, you're now making higher highs and what? Higher lows. Cover call might not be the best strategy for that. I mean, you could, but the investor might say, I'm trying to ride the trend here. Okay? So after 9 or 10 trading days, define the resistance, set the buyback 1 or 2% above the resistance. Okay? Now, here's the deal. If I'm going to leave that out. Okay? Now, stock, it's bullish prior to 9, 10 trading days. And I want you to imagine you put the cover call on, 3 days later, the stock breaks to the upside. Not changing the cover call. And I'm talking about in the paper money. If the stock breaks to the upside, inside our 10 trading days after we put the cover call on, we're going to consider selling a put. Now, wait, if you have a cover call and then you add on a short put, are you making the position more bullish or less bullish? Yeah, now you're actually making the position more bullish. Now, I want to say something just real quick to something that might get brought up. James, why not just roll the call to the upside on that first one? Not going to roll the call to the upside. Why? Because you're rolling into a breakout. Oh, that's tough. No, thank you. Could someone else? Sure. Have you back tested that? Okay, you could, but in our paper money examples, that's not what we're going to show. So the stock prior to 9 or 10 trading days, you put it on 4 days later, etc. The stock breaks to the upside, not changing the cover calls, letting the probabilities play out on the cover call. If that investor says, dadgummit, this stock had a nice breakout to the upside, are there some options available to do a short put or a short put vertical? Question mark. So it doesn't have to be a short put. The short put actually takes more capital, where the short put vertical maybe less capital. Now, could you also maybe do a long call vertical if you want to be a little bit more directional? You could, okay? The more of what we're saying is we're just trying to put on another position to try to increase the delta to try to get a higher dollar amount gain if that trend were going to go to the upside. Now, what if the stock is bearish? The stock drops. Now, here's the deal. So we got to remember what happens if the stock drops. We own the shares and we have a call. We shorted the call and we got a premium. The only protection we have to the downside is, number one, the premium itself, which is not that much typically, or it's just not a lot relative to what the shares are. We could roll the call, one time, okay? The situation usually happens where if the stock breaks or trades below the 1 to 3 month support level, this is where the cover call most likely or would have a stop, or I would say a conditional order. So usually if that stock drops, you got probably one time to roll the call. And what call are we rolling to, Clark? Okay. Same expiration, 20 to 50 days expiration, delta to 30 to 40. But after that one roll, if that stock is still going down, most likely, if someone's being brutally honest, they probably have a stop and they can't roll more than one time because that stock has started to change trend. Now, flat. This is where nothing happens. There's no break of resistance. We didn't break support. And really, after 20 to 50 days, we really stayed in a range. And so if we've achieved 65+% of the option premium, considering rolling again, okay? And what expiration, Clark? 20 to 50 days expiration, okay? The biggest actually thing is it's just kind of more that time decay, okay? Now, when we go through trades in 2026, you're going to see us use this template. I might add some color a little bit to the black and white, but really it's going to be the structure of what we've talked about. I wanted a class in 45 minutes where we could go through really the things that we talked about. So first off, what's the homework assignment? I'd really go back and review this. I'd want to know this so well that I could pledge allegiance to the covered call flag, okay? That I can literally walk through someone an example of what is the covered call, what is it, how does it work, when does it potentially work, what are the risks of the strategy, etc. What happens once you put the position on, and so on. You should know this by heart. You should, even if you don't trade the strategy, you should at least be aware of how it really works and how an investor might consider it. Now, that's up to you to decide if it's something you would consider. I'm out of my time here today, but I want us to walk us through that. Cameron May will be coming up next. And I want to thank you so much for your comments and your participation, and thanks to Michael Fairborn as well. Hopefully this has been beneficial to walk through this in a class session all at once. Don't worry, we're going to be doing more trades on this throughout the year as well. So with that said, remember this has been the class on Investing Master Series. Stay tuned for Cameron May coming up next, and Merry Christmas. Bye-bye.